Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back for another week of Zen and the Art of Real Estate Investing with me, Jonathan Green. Before I get to my guest for the week, I just want to remind you, as I always do, that it would really help us if you subscribe to the podcast. If you're enjoying it, make sure that you share it with your friends. And if you're so inclined, leave us a 5-star review wherever you listen to your podcasts. That's what helps us grow the podcast along the way. And I personally would really appreciate it. This week, we have Fred Moskowitz. He is a well-known mortgage note investor, and that's why we're talking about differentiation. There are other things you can invest in real estate besides assets like houses. We're going to talk about notes. Stay tuned for Fred. This is episode 41 of Zen and the Art of Real Estate Investing with my guest, Fred Moskowitz. Fred is a public speaker, entrepreneur, and the author of the Little Green Book of Note Investing, which obviously we're going to get into. Fred, welcome to the show. It's great to meet you.
Thank you. Thank you so much. It's great to be here.
Yeah, so let's start with where your interest in real estate began, and maybe it began from a different portal than some others.
Oh, yeah. Real estate it's wonderful. A little bit about how I got started, though, is I started out having a very long and successful career. I was working as a computer engineer, and I spent a lot of time working at different technology and startup companies. And what happened, Jonathan, was I watched my entire industry get turned completely upside down during the bursting of the dot-com bubble. And right around that time, we also had the September 11th terrorist attacks.
Yeah.
And so there was all of this turmoil in the world, and the economy was in shambles, especially the tech industry. And so I realized that I was way too dependent on the income from my job. Even though I loved the work I was doing, my job always was just full of so many circumstances completely out of my control. And I learned that no matter how talented of an engineer I was, or how valuable of an employee I was, if things were not going well at the company or in the industry overall, I could quickly lose my job through no fault of my own. And so I came to this realization that I needed to have other sources of income so I wouldn't be so dependent on the paycheck from my job. And that is what inspired me to start learning about alternative investments and the whole idea around buying and building assets that you own, that generate income for you, and can even appreciate in value. And that's what led me to getting involved in real estate.
Yeah, I mean, I think it's common to now as well. There's tons of dot-com layoffs, which is not really called dot-com. It's more like social company layoffs now, or the projection of the possibility, like you said. So you were ahead of the curve. But before that, were you thinking real estate as an asset class, or was it something where you thought, well, to get alternative income, this looks like a good bet?
Real estate was something I saw from different people in my life that I knew, and I saw that they did very well by owning real estate and holding it for long term. And so that was very appealing to me. That was the start, was building a rental portfolio up. And over time, throughout my education in investing and real estate, I was always taking different classes and workshops and learning about different strategies. One of the workshops that I attended early on was being taught by Jimmy Napier, who is an old-time investor, very successful from down in Florida. And he was teaching us a workshop on negotiation. Such an important skill, no matter what you do in life, right?
Absolutely.
So here he was teaching us how to negotiate for real estate deals and buying properties. And I didn't know this at the time, but Jimmy Napier was considered the grandfather of note investing. And he wrote this little book, a really impactful book called Invest in Debt. And during the workshop, he got off on this side discussion for a few minutes talking about note investing and how the idea that real estate is a great way to build and generate wealth when you're getting started. But once you've made some equity, made some profits in real estate, if you can take that capital and then reinvest it into debt, you can really skyrocket your rates of return. And that intrigued me very much. And I ended up buying his book right there at the workshop. I said, I'm going to learn more about this. And then a few years later, I was presented with an opportunity to buy some notes, buy mortgage notes. And so that's really how I got started, and I jumped in. And it's been a wonderful journey since then. That's really how I got started.
Yeah. Was it the potential scale on the assets that was more interesting to you at the time than obviously either single families, multifamilies?
You hit the nail right on the head, Jonathan. It was the scaling aspect. By that time, I started to realize that every additional property you take on, it adds on more to the management responsibilities and the work. And so you get to a point where you start looking at how can you scale to the next level. And with mortgage notes, most of the work that happens is done up front when you're doing your due diligence before you acquire the note. Once you buy the note, you put it with a vendor to manage it for you, and then there's really not so much to do ongoing. And so this is why note investors and note funds are able to scale massively, because it's very easy to build up a portfolio with hundreds of notes or thousands of notes. For any listeners out there that are involved with single family rental properties, think about maybe you scale up to 10 properties, but what would your life look like if you then took that to 50 properties or 100 properties? Now, it can certainly be done, but it does place limits on how much you can scale. And so that was one aspect that was very interesting to me, is that I recognize this is something you could really scale and grow into something big.
Yeah, a couple of things on that. I mean, you mentioned the word asset, which is my favorite word as it comes to investing, because I feel like so many people place the emphasis on just numbers instead of the actual asset. But this is like an alternative asset class because it's more of a paper asset, a note. So did you find that, of course, you can accumulate more paper because you don't have to actually manage those buildings, and that's the differential in scale there, right?
Yeah, exactly. And if you notice something about banks and traditional lenders, they're not having any interest to own property at all. They rather lend on the property, become the secured lien holder in a very preferential security position, and then all the responsibilities of managing and upkeep of the property are borne by the owner. In addition to that, the liability as well. And banks figured this out long ago. And what do banks do if they end up getting a property? They turn around and sell it immediately. They do not want to be in the business of owning property. And so it is a little bit of a different mindset and a different investment thesis that comes into play. But note investing is a very powerful asset class. I've watched so many people around me in the industry really scale and ramp up and become very successful. as well as folks in real estate. You can do very well. I think both asset classes, having both, it gives you a nice diversification. It really does. And so for some investors that are heavily invested in real estate, maybe mortgage notes is a way to diversify a little bit. What I find really appealing is that the cash flow is very steady and consistent. And no matter what happens in the marketplace, if property values go up or down, you're still getting the cash flow on a consistent basis.
Yeah, this is interesting. Let's take a couple steps back for people who aren't familiar with note investing. So explain just to the listeners how you buy mortgage notes and what you're actually buying, because I think it might be confusing for a novice, but it's really not as hard as it may sound. You just have to understand the terms and what you're getting.
Yes, typical mortgage note in the United States, it is, and a lot of real estate investors know about this from the perspective of being the borrower, not from the perspective of being the lender. But when you buy a note, you buy an existing note. Notes are bought and sold on the secondary market every single day. And I'm sure that most of the audience, most of you listeners have had this happen. Let's say you buy a property with financing, or you refinance a property, and wouldn't you know it, but it might not be 2 months or 3 months later, you get that letter from the lender saying, "Dear Mr. and Mrs. Homeowner, please be advised your loan is being sold. And here's the contact information of the new lender. And starting next month, please send your mortgage payments to the new lender. And by the way, don't worry, none of the terms of your financing have changed. Everything's the same, the interest rate, your payment amount, all of that. However, please start making your payments to the new lender." And so this happens every day, this scenario. And what is going on behind the scenes in the secondary market, those mortgages are bought from Fannie Mae or from the originating lender. They may be packaged into mortgage-backed securities. And over time, those securities get broken down and all the assets get sold off again. And so they will change hands multiple times. And for us as investors, we can go into the secondary market and buy those notes. It's not something that's just for the banks, just for the lenders. And so what you get, back to your question, what do you get when you buy a loan? You get all the mortgage documents, which is the note, the mortgage. There's something called an assignment of mortgage, which is a transferring document that gets recorded in the county courthouse where the property is located. It gets recorded on title, and think of it as an attachment or an addendum to the original mortgage. You have the original mortgage recorded, and then all the assignments of mortgage attached to that. And so that gives you the full chain of assignments between lenders when the mortgage is bought and sold. And so what this does, it's called perfecting the lien. And that puts on public record that the lender, the investor, is now the owner of this lien. And if title is transferred or if the property is refinanced, then that lien has to be addressed with the lender, and that will result in the loan getting paid off. And this is what happens when there's a closing, a transfer of title. The title company does that research. They will coordinate with each of the lenders, each of the lien holders, to clear those encumbrances from the title. And that way, if the property is being sold, a clean title is passed from the seller to the buyer. And yeah, this is what we're buying. It's a security position, a security interest that's backed by a payment stream, which is what's spelled out in the note. And the investor buys and steps into the shoes of the lender and now starts receiving that payment stream for the duration of the term of the loan.
And what's the general payment scale? I guess depends on the properties and the loans, but like when you're buying a note, what are you paying and then what do you get back? Are you getting back the full mortgage payments? And how do you determine value in that context? Is different than
It is.
evaluating a house. We're looking at comparable sales, market value, running all these automated simulators that can tell us what a property's worth. How do you evaluate what a mortgage note is worth to you and what the long-term benefits may or may not be?
Yeah, this is a great question. I talk extensively about this in my book, but how to value a note. And really what it comes down to is the yield. You're buying a payment stream, and the note, even though the note may be, as an example, let's say we have a $100,000 mortgage, 30-year fixed rate at 6%. And so that note can be sold at a discount. Let's say it gets sold for $90,000. It's sold for less than the amount owed. The new investor that buys that note for $90,000, they're not going to be receiving 6% interest. It's actually going to be a little higher. It might be 7 or 8% because of that discount. And then if the loan is paid off 6 months later, it's paid off at the full $100,000 loan balance. And so the rest comes in as upside, as capital gain to the lender. And so evaluating this, it has to do a lot with the risk characteristics of the loan and the borrower's profile, as well as the real estate market. We look at the property as well, the collateral. Is there a strong equity position backing the note? All of these different factors, where the location is. And so all of this gets turned into factors that they use with pricing a loan. But in general, everything comes down to the yield that the investor is looking for.
Yeah, so as just a one-off investor, you're able to buy these notes, figure out what the return is going to be. Do you remain in second position, or are you taking over the entire note from the original bank?
Generally, you're taking over the entire note, yes. And so lien position will be the same as it was when it was originated. It could be first position, it could be second position, or any other. Now, back to your question, though, you can buy part of a note. That's a more advanced concept called a partial, where instead of buying, let's say, all 30 years of that payment stream in this example, you might buy just 5 years. And so you'll own a part of that note. That's called a partial, and it is more of an advanced, but that's how that works. So that can certainly be done. It's less common. Usually more knowledgeable investors are the ones doing that because for different reasons. Maybe they don't want to sell the whole note. They just need to raise a little bit of capital. And so it's a great way to invest when you have a smaller amount of capital available.
Yeah. And so where does somebody go to find these? I mean, we're in the real estate world. Most people are looking on the MLS and Zillow. It's pretty easy to find houses, apartment buildings, multifamily properties, commercial properties. Where does one go to find access to buying mortgage notes?
Yeah, that's a great question. Really, it all comes down to personal relationships in the industry. Notes are bought and sold every day between investors, between note funds. There's mortgage note funds, there's investors. We buy and sell notes to each other all the time, but largely it revolves around personal relationships, having a good contact list and meeting people in person is imperative. So it is more work than just going on Zillow or the MLS to find a property. Now, here's something else that I know some investors do. A lot of investors like to buy notes that were originated as seller financing. So this is where a property owner sold a property and carried back a mortgage. And a lot of investors I know, they like to buy lists, which are pulled from public record, of non-bank owned mortgages and then market to them. The same way that
makes sense.
Yellow letters are sent to property owners. Same thing can happen for note holders where it's an individual or maybe it's a person's IRA that owns that note. And so that's certainly another strategy that people have success with. But what we focus on in our business is buying institutionally originated notes that we're buying from other investors, from note funds that are out there, and it's all through personal relationships.
Yeah, if you're comparing those two, the institutional ones are probably safer, I would say, than the seller finance. Would you agree? Just because seller financing deals are usually done in most states by attorneys, but they're not going to be as tightened up in the agreement form maybe as a typical mortgage company.
Yeah, the institutionally originated notes, generally, they're a lot more tightened up and the record keeping is clean on them. So there's definitely some advantages there. But the other thing is there's more of them out there. Yeah. So they're easier to come by. That's a function of the marketplace.
Yeah, I know that you're interested in other areas of creative investing also, but what kind of propelled you? You said you started in traditional real estate investing and you wanted more scale. What started to tip you off that there's more ways? I know you got to this seminar, you read that book, and then where else did you go from there? Because once you open up the concept of creative financing, there's like this kind of treasure of stuff that nobody knows about that you've probably been going through for years now.
Yeah, there's so many. One thing that really led me to learning a lot was learning about the world of self-directed retirement accounts, and which is a very important strategy, valuable. I feel that everyone should learn about this. If you're an investor, learn about self-directed accounts and start using them. Utilize whatever you do. Let's say you do 10 deals a year. Why not do one of those in your retirement account and as an ongoing practice, and allow that to, you're using your skills, your strategies that you're good at to grow something in a tax advantage account. It's so powerful. So this is how I started getting exposed to all of these different strategies out there. People do things like equipment leases and other cash flowing investments. You can own royalties. What are things that generate royalties? It could be a patent on a product or a concept, or it could be, most common about royalties is music and television media, TV, right? But there's book royalties, and all of these can be bought and sold because there's a cash flow stream associated with it. And so there's so much out there. Equipment leases, every town, you have contractors, the guys that have a construction company, all the heavy equipment, it's all leased with equipment leases. And so these are things that individual investors can originate and earn a payment stream from. And so it's not just mortgage notes. There are so many other things. Something that's really taken off, Jonathan, is this idea of merchant cash advances. If you're a business owner, you probably have your mailbox flooded with junk mail from these companies that say, we have a line of credit available to you. You've been approved for $50,000 in funding. What is all that? Why in the last, let's say, 5 years, has there been an explosion of this marketing material coming? It's all from merchant cash advance guys that they lend at very high rates. If you have a cash business like a pizza shop or a hair salon where you have a lot of money coming in regularly, they love lending to those businesses at very high rates. It might be like 30%, but the businesses are borrowing that money just to make payroll, and then they earn it back in a couple days, and then they pay down the loan.
It's
But
terrible for the business person
it
in
is.
general. It can get away from you real fast. That makes sense in terms of the way that I think of it. That's probably how a lot of businesses end up going out of business. They're leveraging to get payroll, but they eventually can't catch up. And then that hole keeps getting deeper and deeper. And then they're like on bar rescue soon.
Yeah, that's that's unfortunate. It's in an area of investing. I don't really get involved in that at all. But the default rate is high, like you said. There's definitely some risk there. But I find it interesting that that type of lending has exploded in the past several years. And I get those mailings every week, and I just throw them out. You get many.
I got a text this morning while I was on another call. I saw the text, and I always see it. Now you explaining, I was like, that's what I just delete them and mark them spam. But I was like, that's exactly what that was. Today's episode is brought to you by Streamline Properties On Market, brokered by eXp Realty. That is actually my on-market real estate team. We have close to 50 real estate agents in 4 states, primarily in New Jersey and Pennsylvania. We work with traditional buyers and sellers and all investors, no matter what you're looking to do in real estate investing. We have you covered. You can get all the information you need at our website, which is www.streamlined.properties. Let me go back to something important that you said. This is obviously about the mindful approach to real estate investing. And part of that we talk about on a lot of episodes is this fact that you talked about building relationships. In these niche investing circles, you can only get to the gold with relationships, and it's not a short-term thing, right? It takes a long time to get to know the right people and for them to get to know and trust you. Because there's not 100,000 people at a conference about note investing right now, because it's complicated. So it does take a little while to build these. How did you do that? And how much impact has that relationship building had on your ability to acquire assets in this space?
Oh, yes. This is such a powerful concept. In our business, relationships is one of the building blocks. It's fundamental. And in the note investing industry, we all know each other.
Yeah.
It's a small world. And so how do you build those relationships? You got to show up. You got to show up at conferences and events, learn how to connect with people, learn how to build relationships. And over time, you start building those relationships. You're doing transactions and being a good trading partner. A lot of it comes down to the way you show up in the world. Do you do everything that you say you're going to do? Do you make a transaction go smoothly? Or do you show up in a way where you make the transaction go difficult with a lot of headaches? And that all leads to your success, because when you do a transaction where everyone has had an excellent experience, that note seller, guess what? The next time they have notes to sell, they're going to call you. They're going to call you before they start marketing out their notes for sale and say, hey, are you interested in taking a look at this? A lot of things come from that, from building up that trust. And unfortunately, not everyone is of utmost trust and integrity. And word gets around quickly when someone doesn't behave in the best light possible. Let's put it that way. And so that's really, really important, because word travels fast. It does. But a lot of the relationships that I've built over the years have come from showing up, from adding value to others, from being curious. And when you have a good track record, that's what is going to be your advertisement for you. Think of it as a personal marketing and advertisement for the way you show up, the way you conduct business on an ongoing basis.
Yeah, I see a lot of similarities to different parts of real estate investing that we've talked about in other episodes. In terms of commercial real estate, it's not what people think. It's all relationships.
Yeah.
Commercial brokers who are selling 200-unit apartment buildings aren't selling to you if they don't know you. And then in the REO space, which is basically foreclosures, which obviously has an ancillary attraction to mortgage notes. But the REO space for real estate agents, they're always trying to get into it because you could get so many listings. But like asset managers aren't just giving those to anyone because they require so much. So it's very similar. That it's interesting to hear you talk about notes because there's so much crossover to the ways of doing business in real estate that I think it's really interesting to see how much it really is all the same. And I've always said relationships are the most important part. Like you said, maybe you can get one deal, but you're never going to get another one if you don't do it the right way.
Exactly. And if you got one and you closed on time, you did everything expected of you that's laid out in the purchase contract, and you were a good trading partner, you're absolutely going to get called back. You're going to get invited back. It's like being a guest in someone's house. If you're a good guest, the next time they have an event, you'll be invited back again, right?
Right.
So always be mindful about your behavior. So here's another thing, Jonathan, another similarity to the real estate market, and that is, let's talk about a note fund. What is a note fund? A note fund is where a fund manager goes out, raises capital through an offering, through a private placement offering. They raise capital, bring that in, and then they take that and go out into the secondary market and buy notes in bulk quantity. And so they can negotiate a better discount. You can get better access to notes. For the passive investors, they are leveraging the experience, the relationships that the fund managers have in exchange for a return on their investment. And so think about this. It's set up very much like a real estate syndication.
Absolutely.
Right? Very similar idea. Even the offerings look very similar, but it's just another similarity where when you scale your business to the next level, you can accomplish great things.
Yeah, and also to note, the similarity to syndication probably plays out the same way. Whoever's managing the fund is the one that you need to trust because they're delivering now multiple or dealing with multiple parties' money at once. So in syndication world, it would be the general partner. If they're not fully trustworthy, the whole thing could go away very quickly, which goes back to what we've been talking about in relationships as a whole.
Absolutely.
Yeah, the similarities across the board are really interesting. And are there any other areas of this creative finance that you've found to be like valuable for you besides these two? Because these, I think, are concepts that now are a little bit more accessible to somebody listening to this podcast. Like it makes sense because it mirrors parts of real estate and doesn't require, like we said in the beginning, you don't have to put the utilities on.
Yeah, it does. Something that I touched on earlier, and I'd like to get into more detail, is the idea of a note servicing company. And this is a very integral part of the vendors that we use in the business. What is a servicing company? What do they do? The servicing company manages the note and does a lot of the day-to-day activities, which include things like collecting the payments from the borrowers. They keep track of the amortization schedule and the accounting on the note. They accept phone calls from the borrowers. They generate the tax statements at the end of the year that have to go out.
It's so funny because you're describing property management. This is like such a great episode because it's so easy to now figure out. Somebody can take as a landlord and say, wait, Fred just told me about property management, but this is what you're saying. It's note management, really. But it mirrors exactly what you do as a property manager.
Exactly.
Yeah.
And so this is one of the most important vendors that we use in the industry, and it really is what allows investors to scale up a portfolio.
Yeah, and also in that same area, the better managers will get all of the business. That's definitely like an 80-20 or 95-5 rule. If you're good at it and reliable, you can get all the business in an area because there's probably others who have mismanaged it. And that's the last thing that you want from someone who's servicing that part of the financial asset.
Yes.
Yeah. Amazing. I wanted a couple questions in the pre-call. We talk about these sometimes, but I'm going to go about Think and Grow Rich, which is one of your all-time favorite books and what has helped you in your real estate career. What are the big takeaways for that? It's obviously it's an old book, but one that like everybody's still reading now. I have my team read it and they're like, wow, it still applies.
It's not only does it still apply, but I feel as you grow and evolve as a person, you can go back in a year from now and read it again, and you'll have a totally different experience.
I agree.
There'll be some other point that resonates. And so the concept of Think and Grow Rich, it really comes down to, and this book was written in 1937, right? So we're coming up on 100 years ago. There's 13 principles that Napoleon Hill laid out in the book. And a lot of it has to do with getting your mindset in the right place, having a strong desire, having faith, having certainty, and auto-suggestion, which is part of visualization. And then some of the more tactical things around organized knowledge and planning, setting out a roadmap for yourself for the things that you want to pursue. And so when you follow this and learn these lessons and apply them in your life, over time, you experience such a massive growth. And here's something funny, Jonathan. Rich does not mean just to money, because you can be rich in relationships. You can be rich in friendships. You can be rich in health and wellness. Just so many areas. And it all comes down to answering this basic question: what do you want? What do you want? Do you have a clear idea of what it is you want and what it looks like so that you know you've gotten it?
Yeah, I think if you look at the scale of what people who get into real estate investing are looking for, they're looking for passive income or ancillary income so that at some point they can create more time. I agree with you completely. I think rich really means time and freedom. The money is what helps you provide that, but you can get time and freedom by streamlining your business and making an amount that's less because it's more comfortable that way.
Absolutely. Absolutely.
Fred, if people want to get in touch with you to talk about note investing, is the best place at your website?
Yes, you can visit my website, which is at fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. That will route you to my website. And once you're there, you can sign up for my newsletter. You can request a special report I have about note investing. Happy to send that out. And if anyone prefers to text me, you can use your mobile device by texting the keyword money to the number 215-461-4433, and then follow the prompts.
Fantastic. And your book, The Little Green Book of Note Investing, is available too. There's going to be a lot of people interested in this because I think you explained in the beginning, it's a little bit less weight than carrying properties, but it does take some expertise, like you said, to get into it. But it's another interesting concept. Really appreciate your time. It was great to meet you. And I look forward to learning more about this. We're going to link to all of your information in the show notes, but I really appreciate your time, Fred.
Thank you, Jonathan. This was a lot of fun and wonderful conversation.
Yeah, appreciate it. I'm Jonathan Green, and that was Fred Moskowitz. This was episode 41 of Zen and the Art of Real Estate Investing. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.